Unless you have been living under a rock these last few years, you've probably heard a ton of information on how quickly home prices have risen over the last few years. You might be surprised to know that the national average percent change in home prices over the last 5 years is 58.4%. But maybe you don't really understand what that means or how to apply that to your current home. So let's talk about home equity, how to calculate home equity example, how to build home equity, what you can do with your home equity, and more in today's video. Hi, I'm Charlotte, your Thurston County real estate broker. We're going to talk about all things home equity in today's video, but stay to the end to find out 5 ways to build equity in your home. First, what the heck is home equity? Investopedia offers a home equity definition. Investopedia says home equity is the value of a homeowner's financial interest in their home. In other words, it is the actual property's current market value less any liens that are attached to the property. So your home equity is the market value of your home minus your mortgage. Let's say that you've done some work on your home and you didn't pay them. You might actually have some liens on your home, and so that would need to be factored in as well. But for simplicity's sake, let's just say that your home equity is the market value of your home minus your mortgage. Let's look at an example to learn how to calculate home equity and also to see how long it really takes to build equity in your home. So a simplified example, most buyers purchase their home with a loan that requires a down payment. The average home buyer puts approximately 6% down, some 3%, some loans are actually 0% down. So it's not the infamous 20% buyers think is required, but that long-standing myth is a video for a different day. Now let's look at this home equity example. Let's say you're purchasing a $300,000 home with a loan amount of $282,000, and your down payment is a 6% down payment, which is $18,000. Right off the bat, as soon as you close on your home, you have $18,000 in equity on your home. Let's continue on and fast forward a year to find out what your equity would be. A simple calculation, remember, is market value of your home minus your loan amount. For a market value, contact your real estate advisor and get a professional equity assessment report, also called a CMA, for an accurate estimation. Zillow will not be your friend here. Then look at your mortgage statement, which should show how much principal is left on your mortgage. If it doesn't and you just want a rough estimate of your principal balance, you can also look at your amortization schedule that you got from your lender at your loan signing. Let's assume that your local market in your area has an average 4% yearly appreciation rate, meaning the home you purchased for $300,000 would now sell for $312,000 after just 1 year. So the market value is $312,000 and your loan amount is $282,000. Now in reality, it would be less because you've been making payments for a year, but since interest rates vary, I'm going to keep it simple and use that same $282,000 loan amount. So after a year with a 4% appreciation on your home, your equity is $30,000. That's the initial $18,000 you put down plus the $12,000 that you gained in market value on your home. And that equals $30,000 in equity on your home. Like I said, this doesn't include the amount you've paid each month towards your principal. That would increase your equity more because the amount of a loan on the home is actually lower, because remember, home equity is the market value of your home minus what you owe on your mortgage. Every time you can lower that mortgage amount, you are increasing your equity little by little. And this continues, right? Every year there's appreciation and you are continuing to pay your principal balance, your equity increases. It builds year over year. So if you're wondering how long it takes to build equity in your home, you can see that it doesn't take long. And while price appreciation has slowed this year, that doesn't mean you lost all the equity in your home. In fact, the latest Homeowner Equity Insights report from CoreLogic finds the average homeowner's equity has grown by $34,300 over this last year alone. Now, this is a national number, but we can see by state what the average change in home price appreciation was over the last 5 years using the map from the Federal Housing Finance Agency, or FHFA. Imagine if you had purchased 5 years ago. What would that look like? Let's do another home equity example. 5 years ago, you purchased that $300,000 home with that same $282,000 loan with 6% down payment. Let's look at Washington specifically. So you have that initial $18,000 in equity, right? And it bumps up to $30,000 at the end of year 1, right? Well, after the last 5 years, based on Washington's average of 66.4% appreciation, your new market value on your home would be $499,200. Now, using that simple calculation, we're going to take $499,200 market value minus that $282,000 loan principal. Again, this doesn't take into account that you've made monthly payments and paid down the principal. So that simple calculation equals $217,200. You would have $199,200 in additional equity just based on that 66.4% appreciation. If you've owned your home for at least 5 years, does this surprise you? Let me know in the comments below how long ago you purchased your home and for how much. I think viewers would really love to see some real life examples. What can you do with home equity? While equity helps increase your overall net worth, it can help you achieve other things. So in which scenario do most homeowners use the equity in their home? The most common scenario is when they move. When you sell your current house, the equity you've built up comes back to you in the sale, and it can be used to cover a large portion, if not all, of the down payment on your next home. Not to mention the higher down payment means a better interest rate. What are some other ways you can use home equity? Another really common use of home equity funds is for home improvements. Sometimes these home improvements are done prior to selling to raise the home's value, or it can be used to upgrade your home to make it more useful or comfortable for you while you live in it. For example, upgrading a kitchen or a bathroom or adding on an additional room to the house. Now, I highly recommend reaching out to your trusted real estate advisor prior to doing any sort of renovating or upgrades in your home, especially if they are done in an effort to raise the home's value for sale, because more often than not, you will not get a full 100% return on your investment. You don't want to waste the money, especially if the whole point is to raise your home's value. So reach out. I'd recommend reaching out even if you're doing it to increase your comfort, just so you have the data. If you have limited funds and want to get the most bang for your buck, I'd recommend reaching out and having a conversation. According to bankrate.com, some other ways of using that home equity include college costs, debt consolidation, emergency expenses, wedding expenses, business expenses, and continuing education costs. I want to caution you on these additional uses of equity. Using your home equity for home improvements or for any of the other items on Bankrate's list is done by getting a home equity loan or a HELOC, home equity line of credit. This is a loan that uses your home as collateral. So if you default on your equity loan, then you could lose your house. So I caution you when you are doing a HELOC, especially for some of those other things on the Bankrate's list besides home improvements, just make sure you are doing your research and really understand what you're getting into. Now, Bankrate's article also discusses things that to keep in mind, like the value of your home might decrease, that there's a limit to how much you can borrow, and making sure that you know what you shouldn't be using those funds for. I'll list the article link in the description below if you want to check out the whole article. Part of the 2008 housing crisis and why there were so many foreclosures is that homeowners were using their houses like an ATM machine, and they owed much more on their homes than what they were worth. Okay, let's talk about how to build equity in a home. There are 5 different ways you can build home equity in your home. Number 1, increase your down payment. We've already talked about the first way of building your equity, and that's your down payment. The more down payment you have, the larger your starting home equity will be. Number 2, pay your mortgage down faster. This can be done a couple of ways. First, pay an additional amount each month towards your principal. This is like the slow and steady wins the race kind of thing. Just keep it up and you'll see a big impact over time. By paying an additional amount towards your principal, you are lowering that loan amount. A little caution here. Some loan servicers have very specific ways of doing this, and if you don't follow their specific process, they may apply that money, that additional funds that you send, towards interest rather than your principal. To see those equity gains, you need to have applied this money to your principal, not your interest. So if you want to do this, check with your loan servicer to see what their process is and also verify that you don't have a prepayment penalty. This is a penalty for paying off the loan early. Also, check to make sure that they did it correctly. Sometimes there's errors, just make sure you're checking up on it. A third way is to use any extra money you get, like a tax refund, work bonuses, overtime pay, or cash gifts, and put that towards your principal. Again, check with your loan servicer to make sure you are following the proper process to do this. Another way that's definitely hard for most people, but I'm gonna bring it up anyway, is to take one of the incomes in the 2-income household and put that entire income towards the principal. Like I said, this is really hard for most people, but it is still worth mentioning. Another way to pay your mortgage down faster is to change your payment method to bi-weekly mortgage payments. This adds one extra mortgage payment towards your mortgage each year. If it's hard to add an additional amount towards your principal each month, see if you can go this route instead. By going down this path, you could pay your mortgage off in 6 to 8 years earlier. Number 3, refinance to a shorter loan term. If you want 100% equity in your home, you need to pay that loan off. One way to do that is to refinance your loan to a shorter term loan, like 15 years, for example. Number 4, get rid of private mortgage insurance. Most loans, if you're not putting at least 20% down, will include private mortgage insurance. This is what the lender is charging you to protect its investment if you don't pay back your loan. Different loan programs treat it differently. For example, if you have a conventional loan, to remove the PMI payments, you need to have at least 20% equity in the home. Once you do, you can contact the lender and request that it be removed. PMI will automatically be removed at 22%. But why would you want to give that extra money to your lender? This is another reason I recommend doing a professional equity assessment report every year. You'll know when you're getting close to that 20%. Now, FHA is treated differently. The PMI is called Mortgage Insurance Premium, or MIP. If you put down a payment of 10%, you'll have 11 years of paying MIP, regardless of hitting that 20% equity point or not. And if you put down less than 10%, you'll pay it for the life of the loan. The only way to get it removed is to wait 11 years or the life of the loan, depending on how much you put down, or refinancing the FHA loan to a conventional loan. Again, another reason to get a professional equity assessment report so that you know when you've hit that 20% and can work with a lender to get refinanced into a conventional loan.
Number 5, increase the property value.
Making improvements to your home can also boost its value and your equity. Remember what I mentioned earlier. If you're going to do a renovation, make sure you check with your real estate advisor so that you can be sure you're doing a project that actually provides a greater return on your investment.
Number 6, wait for home value to increase.
Owning a home is a long-term investment, meaning local housing markets can change over time and your home's value can fluctuate. However, a house's value typically appreciates over time, and the long-run average home appreciation historically is 4% yearly. The last few years of drastic double-digit appreciation is absolutely abnormal, and I think that people think that that's normal now, and it's not. We're headed back into this more normal appreciation levels and fluctuations, which is actually a good thing for the housing industry over the long term. That was a lot about home equity. Thanks for sticking around through to the end. If you're in Thurston County and you have additional questions, please feel free to reach out. I'd be happy to help. I can answer some of those renovation questions as well as provide you with a professional equity assessment report. You really should be getting one of these every single year so you can keep track of where your home's equity is at. And again, as I've mentioned before, there is no pressure here. If you just want that, you have no plans on selling, that's totally fine. I'm not going to pressure you to sell if you ask for one of these. I'm just here to provide value. I hope this was helpful. Thank you so much for watching. I'll see you next time.